And there we go. Hello, everyone. Welcome in. Mic check. See some people already getting the chat going. Hello, everybody. Let's do it. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. It is Tuesday, April 9th, 2024. It's 11 a.m. U.S. Central Time. Welcome in, friends. Great to see everybody. Smash that like button if you haven't already. Consider being a subscriber if you are not subscribed and you just stumbled upon my channel at random. Today we're going to talk about the markets. We'll look at Bitcoin. We'll look at equities a bit. And what I want to spend a fair bit of time talking about is what's been happening in the labor market in the last couple weeks. Some new data came in. There's been a lot of debate about it among Fin Twitters. And we'll talk about all that stuff. So I hope you're comfortable. Glad to see everyone. I apologize for not having a stream over the weekend. I was traveling last week and I thought maybe I could fit it in on Sunday, but my weekend was pretty busy. And then yesterday I took my family out to see the solar eclipse. We were in the path of totality here in Central Texas. So we drove out, took the kid out of school, went and had a nice picnic day with some friends and neighbors, and watched something that only happens a couple times a lifetime. So that was pretty cool. Had a good day yesterday, and we're back now looking at the markets. It's I was paying attention to equities while I was getting the data ready for the stream today, and I just noticed there was like a brief little breakdown in Nvidia. Nvidia set a lower low, which kind of confirms that this is a lower high potentially, even though it's still range bound. And when I first pulled up the charts this morning, this was a big fat bodied candle all the way down here. It has since bounced a little bit, but it was all the way down there. And then I was like, oh, that doesn't look so great. So I was popping over and I was looking at the Dow Jones. This was a whole bodied candle all the way down here. That looked super sketchy. And so I was not worried, but I was thinking that as I was getting ready to make some points about like the labor market, and today we got a small business Optimism survey out today with a lot of interesting information in it. And as I was looking through those things, I was thinking, oh, great. Today's going to be one of those days where the market's absolutely shitting itself and I'm off talking about something completely different. But it's okay. You know, we're still kind of chopping around. Today's not going to be like the doorstep of doom or anything like that. But we'll get into that a little here. But you know, I guess I'll start with the Dow Jones. I mean, might as well. It's right here on the screen. Been watching equities recently. We've been consolidating here for a couple of weeks, and this is a really interesting level. And I haven't talked about this very much lately because the market's been stronger than I originally anticipated, and so sometimes it's better to just wait for more information before you continually talk about a point or a thesis you have or whatever. And one of the things we've talked about here on the channel is how equities are at a full fib extension off the great financial crisis. The Dow is, right? And this just happens to be the place where we've done a lot of consolidating. And having this perspective, and also having the economic perspective that we have with the data that we look at on this channel and the things it suggests to us that are possible, recession and all that kind of stuff. This has been a bit of a nerve-wracking area to be just hanging out at for all major indexes. The NASDAQ is in the same place. And also Bitcoin's sitting at its all-time high while equities sit right here. I'm just kind of waiting to find out, like, how spectacularly wrong is my bearish tilt going to be, or will it be confirmed in a matter of time? You know, that's really hard to know. But as we sit up here every day, I look at the charts and I'm just like, wow, we're just sitting at, we watched everything march up to these key levels. I was wrong in thinking that Bitcoin would be interrupted in its return to its previous all-time high. No doubt about it. I was wrong about that. But the economic situation that informed that bias hasn't structurally improved. It's just that the market has been a little more strong, a little more resilient than I really thought it would. I assumed that at some point the stream of just kind of endless upward gains would be interrupted, and it hasn't quite yet. However, just sitting here at the looking at the Dow, um, feeling like we've kind of exhausted a lot of the exuberance of this rally, which was really the pivot rally. If we're being completely honest, this was the pivot rally because it began in Q4. At the beginning of November, when Janet Yellen surprised the market and said she was going to issue less long duration than the market expected, it was perceived as very bullish, right? That they were going to be supportive of the markets. And then just a couple weeks later, 3-4 weeks later, Powell comes out with a super dovish FOMC. And so this period kind of marked a pivot in the minds of the market, and it catalyzed this strong rally. And just the last couple of days, I guess the point I want to make on the Dow is just how this is just kind of seeing this casual McDonald's arch kind of rejection right here at the 4.236. It makes me a little uneasy, particularly since this came down and broke structure here with a candle close below these wicks. It suggests to me that lower is going to come next, just because of the market structure here. Like here, we've got this pivot, right? And we've got some candle closes here. This is just on a 1 hour chart. I mean, it looks the same on a 4 hour. It doesn't really matter which time zone or time frame you look at. That's a structure break to the downside after a lower high right here. So does the Dow pull back? Is this the beginning of a correction for equities of some kind? I think that's certainly possible, that this has the makings of it after a really powerful move since November. What is this on the Dow? How much of a gain was that? Yeah, 24%, 25%, 24% move on the Dow Jones since November without any real correction of any kind. So maybe we are starting to form that here, but it's not really wanting to go just yet. And I think a little bit of it is being pushed by NVIDIA and the softness in big tech, right? Look at Apple. Apple's just hanging down here at the lows. We've really lost a lot of that momentum that was driving the indexes higher because they were being driven by insane rallies in the biggest companies in the world, right? This was NVIDIA since the beginning of the year. It's the reason why everything went crazy. Some of these other larger names followed it. Meta went with it a little bit. Microsoft also had a little small bit of a rally. But some of the others have been more choppy. Google's path has been more uncertain. I guess Amazon's been pretty strong. But we're watching here at these levels to see maybe equities starting a correction. Over on the Bitcoin side, we're still in the processing the prior all-time high phase. When we looked at the breakout in 2017, there was a push above the prior all-time high. There was a pullback of like 20% or so. And then about a month later, Bitcoin finally reclaimed the prior all-time high and moved away from it. We're in a similar path here, right? It's been about a month since this period back here. Here was the beginning of March. Here's the beginning of April. We're kind of in that same time frame. And if you look at this structurally, I've seen people getting really nervous, traders that I follow getting kind of chopped up in here, not really knowing what the structure was trying to show. I think people expecting just a crazy breakout and up only, and they're not quite getting that. But if you just back out and you zoom out and you look at the structure of Bitcoin from a just price and candles, this is quite bullish. Right? Anytime we've had little inefficiencies, they get filled back in. We continually print higher lows again and again. Every time we pull back into a demand zone and we set a higher low. So this has been really nice, bullish structure developing here around the all-time high for BTC. I don't know what the rest of this cycle has in store, because some of the patterns that I look at suggest that it doesn't have a huge gain based on the diminishing returns of prior cycles. So I'm kind of at a loss in terms of projecting what I think Bitcoin could do. I think I had considered doing a deep dive today into some of the on-chain stuff, but that really kind of takes up a whole episode. So I think maybe we'll put that off. Maybe the next stream we'll kind of do it around the world on Bitcoin on-chain. It's hard to it's hard to merge that in with a conversation about labor market stuff, which is what I want to focus on today. But from an on-chain perspective for Bitcoin, we are seeing the kinds of behaviors that we see at this point in a bull market. In some cases, it looks a little more mature than where we are in this bull market. So what I mean by that is that we're right here at the prior all-time high for BTC. And in this window, which I said we're not going to get into the on-chain, and we won't, but just to kind of give you my perspective on this, we're at a period for BTC. Here we go. This kind of window here, as you're approaching the prior all-time high, it was the same back here. As you're approaching the prior all-time high and breaking through it, these are periods of tremendous on-chain activity, right? That's usually when you have the highest amounts of transaction volumes. That's when you have long-term holders distributing into market strength. I drew this a little too low. It's up here. It's right as you get to the all-time high and then right as you push through it. And that's a behavior that we see in every cycle. Supply comes back online after sitting dormant for long periods of time. It spins into market strength, and that's how new investors get a position. They take it from a hodler. They are given supply from lower down, someone taking profit, and they're buying at the highs. That's the rotation that happens in every market. We're seeing that up here. But some of the things that I think that are got me concerned, I guess, without actually going into all of the charts, is some of the activity levels look like what Bitcoin looked like here back in 2021 here, and relative to the prior all-time high of 20K, the activity looks like we're up here, right? Well, this was double the all-time high. And we're acting that way now at the prior all-time high. So we'll get into some of that next time. Like I said, I don't want to bogart the whole episode about that because it's hard to change topics and go that deep on multiple topics. So we'll save a little bit of that. But if I had to articulate some hesitance, it's because we're in this area for BTC for price. We're at the prior all-time high, but on-chain kind of looks like up here. So that's what I'll say about that for now. But from a price perspective, this is bullish structure. So if you're just trading, trade the action. Don't trade some on-chain thesis. However, confluence is a thing, and confluence looks like we're higher than we actually are. But BTC will lead. So if it's going to continue to develop bullish structure, if it's going to actually break higher, that will be good for crypto. That might help to trigger a little bit more of a bounce in Ethereum, which has been pretty weak. If you just look at these two charts, Ethereum is way down from the prior high, whereas BTC's has gotten all the way back up there. It just looks weak relatively. And the ETH BTC chart has looked terrible until just the last couple of days, exactly commensurate with Ethereum being weak. So if BTC is going to break higher, that will probably breathe more life back into alts. We'll see everything rising, and maybe some new narratives will emerge. Right now, there are no narratives in crypto. There are meme coins, and there is the Bitcoin ETF, and that's it. There aren't any projects building something that's got a bunch of people excited, and so they're aping into it and they're tweeting about it. There's nothing. There is nothing. And so maybe we get a little bit of life. Price tends to create narratives, so we need some price action to give us some juice to get people excited again. I think maybe that's part of what we're missing here. If you think back to 2021, it just felt like every week there was some new project being announced that was going to change the world of finance. And even though most of them went on not to do that, the fact was that there were new products, new projects. There is new buzz almost on a weekly basis. Something dropping, something skyrocketing, everyone getting excited, people making money. And now it's really just limited to meme coins. And even those have been a bit under the weather the last couple of weeks. There's been the momentum has diverged quite a bit. The dispersion in the market has widened quite a bit, and so the number of things running has calmed down. And I think it's just kind of waiting to see, when's Bitcoin going to pick up? When's Ethereum going to pick up? Is it going to, before it corrects harder? Who knows? But I don't think we're going to have more meme coin mania and more altcoin mania if BTC can't turn around and print a higher high here soon. Something above 73K would be ideal. So that's high level thoughts on the market, not going super deep, not trying to give you guys like 10 layers of TA on these kinds of things, because I don't want to zoom in that much on my stream. My trading strategy doesn't have anything to do with my big picture perspective on the market. So I'm comfortable not knowing where BTC is going. Right now, it's just range bound, and it needs to break out of this range to give us some kind of a directional bias. Okay, so let me catch up on the chat, and then I want to talk. I want to talk a little bit about the jobs market. The NFIB small business survey came out with some data today, and also the labor market in general has had some interesting things happening that I have some opinions about that I want to share here today. But first, let me catch up on the chat. Darkchild John became a supporter before the stream even began today. Welcome, Darkchild John. You will be able to join us for the next member stream, which will be in about 2 or 3 weeks from now. Lolek, member for 3 months, says, "Just talk to me, my brother. The longer, the better." Thank you, my friend. Thank you very much for being here. David Kyra gifting a membership. Thank you, bro. Gifted it to Brandon Hammond. Welcome back, Brandon Hammond. Good to see you. What's up, BCB? I see you in the chat there. Crypto Lolik says, "I'm also a TA guy, but you introduce completely different approach." Well, thanks. And I don't really give you guys like the full depth of my TA on here because I do a lot of economic analysis. And so I tend to focus more on that. And I actually like abridge my technical thoughts a lot of times because I don't want this to turn into a trading signal kind of chat. You know, I think we do a good job of looking at data that most people don't look at. And so my default, right or wrong, and maybe you guys want more of this and I'm doing something you're not liking, I tend to kind of abridge my going real deep on TA. You know, I just kind of try to keep it high level, especially in a market that's higher volatility like we're in today. I certainly don't want to get on here and start talking about directional things and have it all be wrong and have people get wrecked. So I like to try to keep it a little high level when it comes to those things. But that's just my perspective. That's just kind of how I think, right or wrong. Okay, let's get into some of this data here because it's been tickling in the back of my mind and I've been wanting to talk about it. So there's been some buzz on Twitter because there is a notable, in the last couple of reports, a notable drop in full-time employment in the labor market. Labor has been a major focus on this channel, particularly the last 9 months or so, as we got deeper into the recessionary process. The cyclical parts of the economy were already in contraction, and we'd kind of ticked a lot of the boxes that happen in the early innings of a pre-recessionary period. And so that means that we needed to shift our focus to labor, because labor is where the sausage gets made. That is what provides everyone with income, obviously having jobs, but it's also the source of consumption, which is 2/3 of our GDP. When we have a recession, it is because everyone lost their jobs, because a lot of people lost their jobs, not everyone. Most people are always employed. But even if just 5% of the country loses their jobs in a short period of time, we incur a recession. That's all it takes. The recession is job loss. So that's why we focus so much on it here on the channel. And, just as a refresher, since we haven't looked at it in a couple of weeks, let's go back here and look at our employment composite. So job growth, is this the right one? No, this is the wrong one. Apologies, friends. So our composite employment metric, which is a blend of non-farm payrolls and household employment, it has continued to structurally break down in recent months. It's well below the growth rate of the 1966 soft landing, which is our most relevant example of a soft landing in history that looks anything like the one that we might be experiencing today. That period saw job growth begin to accelerate about 7 or 8 months in the past from where we are today relative to the yield curve inverting. And we're still seeing job growth kind of structurally break down, though it ticked higher just in the last print. So that's kind of the narrative informing our overall view of what's been going on with jobs. And when we look at it from this perspective, from Fed tightening rather than from the yield curve inversion, it also looks quite similar. The gray line being all prior eras of Fed tightening since 1950. I did leave out COVID because it breaks all the charts. But you can see today in the black line, job growth still slowing down, still suggesting that it might continue to get weaker. So inside of jobs, there are a bunch of layers, right? We've gone through a bunch of it here on the channel. There are people who work part-time. There are people who have multiple jobs. Sometimes those jobs are one full-time job, one part-time job. Some people work 2 part-time jobs. There's folks in and out of the labor force. There are people who are on unemployment. There are people who don't have a job and not on unemployment, but they'd really like to be working. There's all these different groups inside of labor. It often gets simplified down to who is employed and who is unemployed, but there are multiple facets inside of it, and sometimes they can have quirks related to them because of the questions that get asked on the survey to get those numbers. So that's what we're going to talk about a little bit here. We're going to start with these 2 lines. So I opened up this segment talking about how there's been a drop in full-time workers, right? So let's zoom in on this a little bit. Since 2020, right? Actually, let's zoom in a little more. It's kind of hard to see. Here we go. Take off that COVID drop. This is at the top within the labor market, people who are employed usually full-time. And down at the bottom, people who are usually employed part-time. Now, full-time workers has been structurally breaking down since November. That was the high in full-time workers, the all-time high in the total number of full-time workers. And it has fallen, I think, every month since then. Yes, it has fallen every month since then. And in that period of time, part-time workers has risen every month, while full-time has been falling. Part-time is a much smaller group. It's about 1/5 of the size of the full-time group. But together, they make up everyone who's working. And there's been a lot of consternation and debate going on FinTwit because the bulls are posting about how there are people who work part-time and they're doing it because they want to. Let me tell you what I'm talking about. So inside of the labor market, we have 2 different things. We have part-time for economic reasons and part-time for non-economic reasons. Let me show you. Part-time for economic reasons, non-economic. What's the non-economic series? Here. Okay, let's add these to a chart together. Okay. So we've got in red, part-time for what's called non-economic reasons, and in blue, part-time for economic reasons. What are those? If you were part-time for economic reasons, you were forced into working part-time when you would rather be working full-time. So if you were part-time for economic reasons, it's because the business made you do it. They cut your hours, they moved you into a part-time role or whatever. You would rather be working more. You actively want to be working more, and you can work more, but you are prevented from doing so. So that's a negative. Blue is negative. You're part-time for bad reasons. Now that's been rising a little bit, but let me put these on different axes just for a moment so we can see the movement in them. So the blue line has been ticking up a little bit, but you can see it's really choppy. And part-time for Part-time for economic reasons is one of the data points we use when we look at labor components in the recession dashboard. This is one of them. But non-economic reasons is everybody else. It's everyone whose job did not force them into part-time work when they were preferring to work full-time. And this line is the one that has been cited recently, and it's being characterized as bullish. And I'm just not sure that I can get there, and I'll explain why. So we've got rising, really rising sharply, part-time for non-economic reasons. And so the narrative from the bulls from this is that this shows that the labor market is strong and that people have optionality because they are choosing to work part-time. And if they were choosing to, it must mean that they don't need the money and that they're doing okay. That's the narrative. And the reason why I think that is total bullshit is because the BLS gives us all of the reasons someone would choose non-economic part-time work, and most of them are negative. So here is a table from the BLS website, and it's about who chooses part-time work and why. And they have this table, and it is all of the reasons why a person would work part-time. So let's look at them together. First, it says, the responses to these questions are used to classify part-time workers as economic or non-economic. The distinguishing factor is that people who work part-time for non-economic reasons do not want or are not available to work more than 35 hours a week. 35 is considered full-time. So what are all the reasons that a person would choose this? Childcare problems. It's because of the affordability and availability of adequate childcare. Other family or personal obligations. Maybe there's someone staying home sick with a child, doing housework, chaperoning a field trip. That's not necessarily a bad reason, but staying home with a child, staying home with a sick family member. Well, we're only 4 years removed, 3 years removed from a pandemic, right? Health and or medical limitations, illness, injury, or disability. The number of people on disability claiming medical disabilities has skyrocketed in the last few years. Here's a good reason. School or training. You're working less hours because you're going to some type of trade school or you're getting extra education. Maybe you're retired. You work less than 35 hours because you're retired. Or maybe you can't work more without losing Social Security benefits. Maybe your full-time work week is only 35 hours. There are some jobs for which that is the case. And then there's a couple of others, like just any other reason is reported. Maybe they just left an other reason. Gave economic reason, but is not available for full-time work. Reported that they want to work more, but they're unavailable to for whatever reason. Maybe they don't have reliable transportation. Who knows? But I think the main takeaway from this is that the majority of these reasons are negative economic trade-offs, right? You're choosing to work less because childcare is not affordable or available. You're choosing to work less because maybe you have someone at home that requires you to be there with them. We've had a lot of family situations changing in the last years. We've had a lot of health problems manifesting in the last few years. Here, your own personal health problems could also keep you at home. Maybe you're retired, and if you work anymore, you're going to have your Social Security benefits cut. These are mostly negative trade-offs. The best one is, well, it's because I'm going to school, or I just choose not to. But most of them are negative trade-offs. And I think that's really the story here. Because if you look at the trend of part-time workers, they don't rise in this fashion in a healthy market, in a healthy economy. Let me show you some different charts. So these are the two lines we were just looking at, part-time and full-time. Up here at the top is a ratio of full-time workers to part-time workers. Down here at the bottom is the 12-month change in this line. And so if the line is going up, it means that there are more full-time workers relative to part-time workers. We want more full-time workers. We want people at full employment, working as much as they possibly want to work and earning as much as they're capable of earning. And when the line is falling, it's because there is more part-time relative to full-time. You can see over here, because of the dynamic I just showed, because this one is going up and full-time is falling. Full-time, oh, sorry, this is not the chart. It's this chart. I'm sorry, guys, for hopping around. Since we can see over here that full-time is breaking down and part-time is breaking up, this ratio is breaking down, the ratio between the two of them. And on a rate of change basis, this is not a dynamic we see outside of recessions, typically. Right here, this changed because there were some calculations that changed in the BLS survey. So we're going to ignore this single dip right here. Just look at the rest of the chart and notice how typically when we have these big breakdowns, the only other time we saw one was back here in the late 60s. And this was a period of time where our demographics were undergoing a great transformation, right? We had the boomer generation coming into working age, the biggest generation in US history. And that also started the dynamics of females being more career focused and entering the workforce in larger numbers. Those things really started happening late 60s, early 70s. So what we're seeing over here, it could go one of two ways. Either it's because we're undergoing some kind of a demographic transformation and it's hard for us to really see what all those effects are. You can make that argument, right? Because we have boomers that are at retirement age. We're not having as many children before. Our population is getting older. Maybe some of those people are having to come back to work. I'm not really sure. We'll try to dive into more of that, over the coming months and see if we can learn how this dynamic is affecting things a little more. But just on the surface, this breakdown in part-time or breakdown in full-time relative to part-time workers is a recessionary dynamic. And when we think about what we were just looking at, why all the reasons someone would choose part-time work, the top 3 reasons are negative economic trade-offs. I can't afford childcare. I can't afford to leave my mom at home all day long by herself with like a healthcare professional. I have health problems and I can't go to work for longer than that. There's multiple reasons. We just had COVID. It was just three and a half years ago. It affected a lot of people in negative ways, not just the virus, not just closing down the economy and locking people in their houses. Those things all had major effects, but then the vaccines themselves have had effects on people, allegedly. So who knows all of the factors affecting people's health? We've had major societal change in the last few years, and we're in an inflationary cycle where the familial balance of costs, like the balance inside of a household, the things that they have to decide to pay for, the trade-offs they have to make, those things are changing. Because groceries are like 35% more expensive than they were 3 years ago. These are very real decisions people have to make, and they have to decide, are both of us married couples, are both of us going to go to work? Can we do that? Or does one of us need to stay home and we find ways to pinch pennies because you need to watch over your mom and our young kid because we can't afford $1,000 a week in childcare? These are very real problems people are facing right now. And I think when you see a really sharp increase in part-time workers, which is not a dynamic that we usually see in expansions, It raises a lot of questions in my mind as someone who likes to dig around in data. And when I hear people telling me that it's unequivocally bullish, I just can't see that logic. I can't see it. Here's a different perspective of the same changes to the labor force. Everything is anchored here at 0 from January of 2022. That's right before the Fed started raising rates. In fact, we're just going to cut off the chart at January 22, so it's not confusing. Okay. And here we have 4 lines, and it's their percent change since the Fed started raising interest rates. Non-farm payrolls, this is the main job number, right? That's the one that you hear on the news. That figure is up about 4.5%. Household employment, that is the other piece of the labor market. We combine these 2 lines together to get our employment composite metric that we use in all of our charts to compare prior recessions. That figure, household employment, this is the one asked to businesses. This is the one asked to households. That one is weak. That one set a peak in November of 2023, and it has been chopping around here for the last few months. But here's the two lines that I think are the most interesting: full-time and part-time. And you can see how, as the job numbers have continued to post higher and higher totals, full-time workers are not contributing to that anymore. They've actually broken down, and part-time is filling in the gaps. And the vast majority, if not all, of the net job gains in the last 3 months, basically since the beginning of the year, have all been from part-time workers. It's hard to say that that's a healthy labor market. If it was a healthy labor market, we would have more full-time jobs. But we're not seeing that. We're seeing more people taking part-time employment. Maybe that's 2 jobs. Maybe they're working 1 job. The metrics for multiple job holders have not really exploded in the way that you would think when you see something like this. But it's just part of the nuance of the labor market. And I keep coming back to, we're either undergoing some kind of a dramatic transformation that we can't possibly understand fully right now, or we are drifting into a recession in the biggest cycle ever, and this is just another sign of it. I'm kind of in the middle on those things. I'm leaning towards, we're probably going to deal with a recession at some point, but I've had to accept the fact that the economy has been a little more resilient than I thought, and that the markets have been a lot stronger than I thought they would be, at least for Bitcoin's sake. And so I can't say for sure that we're going to have a recession, not when we're running 8% deficits with full employment, seemingly to no end, and there's no real political appetite for drawing those in. It's hard to know what actually derails this train, because it's really an avalanche at this point. Meanwhile, labor continues to weaken. If we look at this ratio, right? So I showed you this ratio, and I showed you it breaking down, and I told you that's concerning. The only other time we really saw that was back here in the beginning of the 60s, or the late 60s, and that was the beginning of this metric. So I don't even know what it looked like before that, because this is when the data began. However, let's look at this ratio relative to when the Fed starts tightening, because that is a time anchor in every cycle that usually begins the process of what ultimately leads to a recession. It's just that the Fed usually starts tightening much earlier in an expansion. They began quite late this time around, which we've talked about a lot on the channel here. But this ratio relative to Fed tightening in all prior eras, going back as far as the data will go, these should not be on here because these don't exist on this data series. There we go. Here are those data series. And here is 2022 and 2020 to 2024. This is our current cycle, and it is the ratio of full-time to part-time workers. It is broken down harder than any other prior era. The only other one that even looks remotely similar is 1973 to 75, and that was the worst recession since the Great Depression at the time that it happened. I don't really like to see that comparison there. But just to kind of show you how weird it is that we would have such an explosion of part-time workers and such a weakness of full-time workers, but still claim full employment. It's very strange. It's very odd. And it's just really got me scratching my head. And it also, just because people have been continually faked out by this cycle, I have a suspicion that this is telling us something that we just don't quite understand yet. And it just goes in the pile of more labor metrics that look pre-recessionary, right? The number of people claiming that they are unemployed has risen at the fastest rate ever without a recession. The number of people working part-time has risen at the sharpest rate ever without a recession. The number of people working part-time relative to full-time workers has changed at a pace never seen outside of recessions. Manufacturing PMIs were below 50 for the longest period ever without a recession. The yield curve has been inverted for longer than any period ever in history without a recession. Real retail sales have been stagnating for longer than any period ever without a recession. There are more and more of these things stacking up. The longest thing that we've ever seen without a recession. Yet another recession signal that has been this way for longer than we've ever seen before, and still no recession. And as someone who studies business cycles, that's just wild to me. I tweeted about it the other day, actually. Let me show you guys, because there might be a couple of the points on there that I missed. Yeah. Biggest fall in full-time workers ever without a recession. Biggest rise in unemployed workers ever without a recession. Biggest increase in part-time relative to full-time without a recession. Longest stagnation in real retail sales ever. Fastest, deepest slowdown in bank lending ever without a recession. Biggest year-over-year drop in federal tax receipts ever. Longest streak of manufacturing PMIs below 50, longest yield curve inversion, longest streak of negative leading indicators ever. In a cycle where the Fed was later to arrive with hikes than ever before. Is this the most successfully engineered soft landing in American history? Or is this cycle bigger than anything in a century and we haven't seen the final act? That is, if I had to sum up everything I'm looking at, it's that tweet right there. And is it any wonder why someone like myself has been bamboozled a bit by the strength of this economy? And it's a fact it's a fact of life, and also a little frustrating as an analyst that you could have had the most ape-brained left curve take possible during this whole cycle, and you would have been correct. All you had to do was go print money, long assets, and just stayed long everything, and you would have been correct, and you'd still be correct to this day. And that's probably one of the harder things about this cycle, is that we have all of this, and still it's unclear what the final outcome will be. If we go another year and a bunch of these things still look the same, but we still have at or above potential GDP growth, and we still have at or near full employment, then this will be the most successfully engineered soft landing in American history. Jerome Powell's legacy will be cemented as of one of the GOATs, even though he has fucked up multiple times as Fed governor, Fed president, Fed chairman, whatever his title is, chairman. And that will be a tough pill for someone like myself to swallow, who has seen such an insane cycle relative to everything before. Rates of change just totally blown out of the water. That would be a difficult. I want that for my bags, because I am long. I want to make money. You make way more money being long than you do being short. I want to be wrong. But if I am wrong, then it really shows that you can just completely ignore negative data if we're going to go ahead and run 8% deficits of full employment. We could just let's just ignore everything else, because that's the only data point that seemingly matters. If that is the actual outcome we get, if we go another year from here and nothing happens and everything seems fine, and if, God forbid, things actually begin improving, like what if they lower interest rates and then credit just starts cycling again, right? People start lending, the banks start lending, consumers can access debt again. We just somehow nothing blows up. I mean, that's possible. And in this Frankenstein economy, you can't rule those things out. This is not a science. When we study the rates of change of economic data, this is a soft science. There is no hard rule that says when X happens, Y must follow. All you can do is look at sequences of the past and make educated guesses, which is what we do here on the channel a lot. But you can see how, just at this tweet here, the one that's on the screen, you can see how being data-driven can still lead you into a cul-de-sac. If the fiscal authority is running the largest deficits in peacetime that the U.S. has ever seen. And I think that that just has to be acknowledged, that even though we're seeing weakness in labor, we're seeing full-time workers dropping off a cliff, rates of change of job growth slowing down tremendously. We are still at relatively full employment. And they're just going to continue to run massive deficits because there seems to be no political will to pull back on those things. They're kind of pre-programmed in a way. And it really just makes us look like an emerging market. It makes us look like a fucking banana republic. And that's just crazy because we issue the world's reserve currency. Running on credit, that's why. Yeah, Ben. I mean, if you think about it, every dollar is the credit of the United States. Every dollar is a promise on you to be able to cash in on some tiny piece of the full faith and credit of the United States. That's all it is. It's not tied to some capital stock somewhere. Every dollar is a promise. It's a promise to redeem for a dollar in the future. And it's backed by the government's full faith and credit of the U.S. Every dollar is a promise. We're running on credit. When we run massive deficits, that credit is just coming out of the sovereign rather than coming out of commercial banks or coming out of households. Let's look at some of this small business NFIB survey. There were a few data points in here that I just thought were interesting. This is one of the softer pieces of the labor market that comes out, and it goes well with the ISM surveys, which are asked of a different group of businesses. But this mostly focuses on small business, and a lot of these businesses would fit into the Russell 2000. I don't know how many of them are actually public companies. I haven't looked into that, but a couple of the things I noticed in here, I'm not going to go through this whole thing, but it just seems like in the commentary from the small business data that came out today, that inflation continues to be a problem. Two streams ago, we looked at the rates of change of inflation, and we noted how several components inside of the basket are picking up on 6-month, 3-month, 1-month annualized rates, and they're faster than the year-over-year rates. So just the measured price inflation is picking up. And if you listen to business owners, they're saying the same things. So on here, the net percent of owners raising prices rose 7% from February to a net of 28%. A quarter of owners reported that inflation was their single most important problem in operating their businesses. The small business sector is showing signs of a potential slowdown in economic activity, with net sales expectations falling 8 points. Continued stress in navigating inflation pressures leads as the top business problem. Inflation continues to frustrate owners, as a significant share of them still report it as their biggest problem in operating their businesses. Here is a look at the index of business optimism. So you can see it's been declining since 2018, and COVID was a big shock to this. But business optimism out of this group has actually broken down further. I know that this chart is a little grainy when I zoom in on it, but right here it's setting a new low, and that low is from late 2012. So business optimism in small business is the lowest it's been in 10 years, 12 years. That's a terrible figure. Here's the figure right here, 88.5. You can see that number is nowhere else on here. And it's been declining each month, been ticking down 90.7, 90.6. So it ticked up in December, and it has dropped for the last 3 months. What are these two black lines here? Hard data: job creation plans, job openings, earnings, capital expenditures. Soft data. Let's keep going. Here we go. Uncertainty. There was another one on here I wanted to look at. Here we go. Good time to expand. In the thick black line, man, these are really grainy. I'd love a higher resolution version of this report, but this seems to be the best we've got. This thick black line is businesses saying that it is a good time to expand. That's continuing to break down. Actual total business conditions are way low. They've recovered from 2023, but still below the entire like 30-year series. That's a little bit shocking. What else did I see on here? There was one of them, I think it's a little further down. Most important reason for expansion. Earnings still quite low. Sales are still quite low. Prices. No, it was one of them in here. It was having to do with their borrowing rates. Where was it? Oh, here we go. Planned next 3 months of employment. Job openings are falling. Planned hiring is falling. It's broken down with the exception of the COVID flush. Planned hiring has broken down to 2017 levels out of small businesses. Where is the rate? I wanted to look at the interest rates. Credit conditions. Availability of loans. Here it is. The net percent of businesses saying that it is easier versus harder to find business loans compared to 3 months ago. So if this figure is more negative, it means that more businesses are saying it's harder to get loans versus easier. This figure is at -8. That is one of the lowest values on this chart since 2019. And you can see it's been hanging out at this value since the second half of last year, -8, -7, -8, -8, -6, -7, -8. And this ties in a bit to what we've talked about with businesses being unable to access credit because we raised interest rates so hard, so fast, right? This chart. Most debt was acquired here. We raised interest rates incredibly quickly. The Fed said we're going to cut this much, but businesses actually need this much cuts just to get interest rates back into a range that's somewhat comparable to when the last time they accessed credit. But the ability of these businesses to access loans remains at a depressed level, arguably the most depressed level they've been at for this whole cycle. The actual tick low was March of 2023, but we're pretty much at that level now. And when you look at the rates, the relative rate that they're paying, is there a table for that? Yeah, relative interest rate paid by regular borrowers. Look at this. Look closely at this. Let me put this on 2 pages for you. Here we go. Shrink this. Can I shrink this down? Yeah, you just put this over here. Here we go. Okay. Now I said most debt was born down here, especially during this period, right? This is when COVID hit. This was after Powell's pivot in 2019 when he started to lower rates, and then we cut him to 0 in COVID, and then he started raising here in 22. And this window of time is when a bunch of debt was created, a bunch of terming out of debts. Look at this table. Look at the year 2021. This is the relative interest rate paid by small businesses. Look one row below this. It went from 2 in August of 2021 to 21% in 2022 and 24% in just this last August. Now, it has subsided a bit, but that's because yields themselves came down a bit, right? The market itself eased conditions on its own because it anticipated Fed cuts. But because the economy has been so strong, now the Fed is walking back some of that bullishness, walking back some of that dovishness, and it's possible they won't cut at all anytime soon, maybe not till later this year. We'll have to find out. But just to really bring home the starkness in how borrowing costs changed for businesses, it's right here. Oh my God, look at the yellow. That's insanely thick. Let's do this. Here we go. It's right here. Look at the borrowing costs. Look how they went. They went from 0 to 26% in 2 years. So when you're looking at the commentary in here, BLS, no signs of labor weakness. One half of the Fed's mandate looks good, which is full employment. The other half is still frustrating Main Street, meaning inflation. In the meantime, small businesses will have to manage higher financing costs a bit longer. This is the Small Business Survey providing this commentary. And then we go down to that table. Oh my God. Yeah, this table here. Look at the change in borrowing costs. Is it really any surprise why the Russell 2000 looks like this? These are small businesses. So small businesses feeling it. And the reason why they matter is because they employ about 40% of the country. They're responsible for about a quarter of GDP. Small business matters a lot. A lot of times the Russell gets joked about, yeah, well, if they were good companies, they would become large companies and they would move up into the S&P or the NASDAQ. That's true for certain kinds of businesses, but there are a lot of businesses that are run extremely well, that are very valuable, good quality businesses, and they will never be a large cap just because of the nature of their industry. And they are in the Russell, and they are a small business, and they will always be a small business, and they're fucking hurting. And it's this chart, and you see it here on the data. And when I saw this mainly right here from 21 to 23, like that's nuts. That's nuts. And this affects businesses differently, right? There are cash rich, large cap businesses that are not dealing with these problems at all, right? Because of the nature of their finances, they can probably access credit much cheaper. They may not even need to. They could issue their, they have more options available to them, being larger entities, being more credit-worthy entities. Small business is more cash strapped. They are more debt dependent upon growth. And so when they can't access debt, or when it goes from 2% to 24% in a 2-year period, that really squeezes them. And that's what I've been talking about this year, that if the Fed is in a policy trap where they got really excited because CPI came down really sharply. But what they failed to recognize was that it stopped going down, right? The second derivative of the components slowed down. It changed, and it went from being a negative to a positive. And so CPI has actually been stagnant since June of last year. But the Fed got super bullish during this period of time, and the market started anticipating tremendous amounts of cuts. And now the Fed is having to walk those things back because CPI ticked back up to 3.1. If we look at inflation nowcast, I think it's at 3.3. We're going to get that this week. I think it's tomorrow, actually. Tomorrow is CPI. Inflation nowcast says that it is likely to be 3.36%. Or sorry, 3.41%. Inflation nowcast is calling for 3.4. The last print was 3.2. The one before that was 3.1. So if we get that, that will have been 3 months of us ticking up, right? Basically all of 2024 so far, we will have been ticking up on CPI, not back up to 8-9%, but it isn't continuing to go down. And as the analysis told us 2 weeks ago on stream here, there are components inside of the basket that are actually accelerating, at least somewhat accelerating, to the point where the Fed will find it difficult to justify cutting interest rates. And this commentary even mentions some of that. Listen to this. This is what the people who put this survey together think. Inflation continues to frustrate owners. The Fed has taken notice. The 2024 schedule of anticipated cuts has dropped from 6 to 7 down to 2 to 3 cuts, maybe. Fed President Neil Kashkari has suggested the possibility of suspending rate cuts all of this year, moving the first one to 2025. The data is certainly not supportive of cuts at the next 2 FOMC meetings. They are saying this even though their own survey of small businesses is telling them small businesses are hurting. They're still saying the Fed doesn't have a clear option to start cutting rates here. They're going to have to make the argument. They say cuts at those meetings are off the table. They actually think that there won't be any cuts for the next two FOMC meetings. What are the next two FOMCs? April and June. So according to the small business survey folks, they think it's possible the Fed doesn't even cut till maybe July, the end of July. And that's when they said here, in the meantime, small businesses are going to have to manage higher financing costs a bit longer. They're managing this. They're managing this right here. Oh, this net percent higher. Okay, so it's not a 20%. It's people. I misread this table. It's not the actual interest rate. It didn't go from 2 to 20, but 0 of them were reporting higher rates, and now 25% of them are reporting higher rates. So it isn't as crazy as I looked. However, it went from none of them having credit problems to at least a quarter of them having credit problems or having trouble accessing rates at their prior cost. So my interpretation of that was a little off, but the message remains the same, that credit is difficult to access for these small businesses, as seen by the relative rate up here and this diagram that we've talked about. This is what's really on my mind the most today, though, is the fact that we've been seeing part-time exploding while full-time has been softening, and full-time is softening commensurate with the actual household survey, which is one of the two employment surveys. Employed full-time looks a lot like the household employment survey. If we keep both of these only, you can see, look, they look really similar. And this is the breakdown in full-time jobs that became part-time jobs. Let's just look at those two. Right there. There's the breakdown in full-time, the breakout in part-time jobs. Are they doing it for good reasons? Or is it because childcare costs and healthcare costs, or maybe Social Security benefits, are keeping people from wanting to work more, even though they'd like to? Right. Let's see what I've missed in the chat. I see a couple of messages. Andy Philpott with the donation. Thank you, Andy. Very generous, my friend. Thanks so much. If you haven't hit the like button, please do so. We'll probably wrap up here in a minute. Let's go see what's been going on in the market since I've been chatting and rambling about labor stuff here. Yeah, we didn't touch on gold, so I think it's just worth mentioning here that gold has just been on an absolute moon mission. And I've been getting asked quite a bit recently what I think this is happening for, why I think gold's going higher. And my answer has been, I think it's multiple things. The easiest answer for someone in the West is to say, well, it's because of the deficits. It's because we're going to print a lot of money and people can see that coming. Just like in 2020, everyone bid up gold because we were printing money to no end. And maybe that's true. But the deficits have been this way for over a year, and gold just recently started ripping. It was consolidating for a period of time, and now it has finally broken out. So is the market anticipating a bunch of dollar debasement? That's possible. When you see the deficits as far out as they are, just being as deep as they are, that is a sound argument. But what I think is more realistic for what's happening to gold just here in the near term is China. And there's evidence. So I saw Eric Balchunas tweeted something. I'll go find it because I think I retweeted him. There was a gold ETF that got halted because it got pushed up to a 30% premium because people were bidding it so hard. A Chinese gold ETF, not in the US. And that's been going on. I looked for a chart, but I couldn't find one of China's gold holdings and how they have exploded. Both the central bank and estimates of private holdings of gold in China have both skyrocketed in the last couple of years, so especially in the last year. And we're seeing a drop in the holdings of the US gold ETF, GLD. Those holdings have been coming down while there is clear demand for gold in China. And so what I think it is millions of Chinese trying to escape their native token, right? Trying to get out of the yuan and yuan denominated assets, because that currency is weak and it's in a dangerous place. And the Chinese have a storied history of rejecting paper in lieu of specie. Just a week ago, a little over a week ago, I did a stream called A Modern Mania of Paper Money. If you haven't listened, I really urge you to listen to it like a podcast and just hear the parallels in history. We dive into ancient China. We talk about a money crisis in Austria. We look at America in the 17 and 1800s. And one of the major stories out of that deep dive that we did together was the long history. We're talking millennia of history in China of them having terrible experiences with government issued money and rejecting it in favor of gold and silver and copper and actual goods. They went through so many cycles back in ancient China, and those things persist to this very day, although they've taken on more modern forms. Right now, when you look at the yuan, you see its weakness. It's up here. This is weak relative to the dollar. So as this goes up, that's the yuan weakening relative to the dollar. They've kept it in this range for a long time, and it's finally starting to weaken. And when you look at the problems facing the Chinese government, they have way too much debt sitting with their local governments, and the only real release valve is for the central government to absorb risk or to try to print their way out of it. Those things can be the same, they can be different things, but it appears that the Chinese government's running out of options, and either they're going to experience even more economic stress or they're going to try to print their way out of it. And so the Chinese are trying to get out of yuan denominated assets. Gold is the most readily available thing for Chinese people to buy because they don't have as many options as we do here in the US. They have a closed economy. They put capital controls in place to try to prevent outflows. And so while there are savvy investors have savvy ways of getting money out of the country if they want to, the average person can only really buy gold and get gold exposure. And I think that's a huge reason why we're seeing gold pushing higher. And it's at all-time highs in like every currency. But it's doing that while the US gold ETF holdings have been falling, which means people have been redeeming out of it while the gold price continues to go higher. And I think it's because demand in the Eastern Hemisphere has taken over as the pricing mechanism for gold. And Asia is pricing gold today. I think that's what's happening. Either way, seeing gold all the way up here is a bit nerve-wracking. This is all-time highs for the shiny yellow metal. It's really hard for me to take Bitcoiners seriously when they constantly claim that no one gives a shit about gold anymore, when clearly the people of China very much do, and there are a billion of them. So yes, people do care about gold still. It's not just about Bitcoin, but its role is a little different. But as long as central banks find gold interesting, it will continue to play a significant role. And central banks have been buying gold in large numbers since 2022. Ben says, I feel like the Chinese will play a bigger role in the upcoming downturn. Yes, what I think that this decade, what ends up happening as in terms of global growth, I think is much more at the whims of China than it is the US. And I think really if you look back to the 90s, to we had the Asian financial crisis in the late 90s. We also had earlier in the 90s the collapse of the Soviet Union. The 90s were a period of greatly expanding globalization, right? We brought Eastern Europe and the Chinese economy into the global economy. We had a massive labor dividend as a result of it. And the West and China together found a new growth engine that really powered things for about 20, 30 years, really about 20 years. And a lot of that had to do with changes that went on in China and their willingness to be the sponge for global growth. And they chose to put a lot of that money into infrastructure, into manufacturing, and then into real estate. And they've developed significant overcapacity in a lot of industries. They're trying to pivot as right now. They're trying to invest in new things, but they still have significant overcapacity in things like bumper steel and solar panel equipment and things like that. EVs, they've produced way more than global demand currently can hold. And so there's all these stories coming out about different countries getting pissed off about China dumping goods on their markets. Brazil is one of those. And so they're in a different place now. And however they decide now to work through their problems and create growth, if they can, what they decide to do, I think, will play a major role in the ability of the globe to grow over the next 10 years, because most global growth has been tied at the hip to China. And that's not going to change overnight. We can't just decide that India is going to be the growth engine and just make that happen tomorrow. We have to build the infrastructure, and the entire world has to agree. The Western world has to shift in that direction, or the dominant economies have to shift in that direction, which is what they did about 30 years ago. So whatever goes on in China, I think, is going to have a big role in how the path of global growth goes. Because if they can't be a boon to growth, and they become more of a neutral factor or even a drag, then someone else has to step up. It's going to put a lot of pressure on the US. It's going to put a lot of pressure on Japan, a lot of pressure on the EU. And whether or not the three of them can work together to fill in the gaps of Chinese growth is yet to be seen. Whether China can convert their entire economy into some modern manufacturing hub rather than the one they just stopped being, or the one that they're trying to stop being, that is yet to be seen, because they won't be able to push all of the debt growth onto their local provinces the way that they did in the 2000s and the 2010s. That's how they got into this situation in the first place. Do I think it's possible the Fed raises rates this year? I don't think the Fed raises rates unless inflation jumps significantly. I think if we were to see CPI over 5%, there would be more talk about the Fed raising rates. But I don't think that they're going to do that. I think we're pretty much at terminal. And I think the best thing that they can do, I don't want to say best. I think the thing that they are more likely to do because of the mixed signals is to just try to hold rates here for as long as possible. Like a really long pause, if we get to July, it will have already been a year, which is a pretty long pause. So I don't think they're going to raise again. I think if they were to start raising again, like I said, it would have to be in reaction to inflation getting out of control. Otherwise, it makes them look like they don't know what they're doing. They already kind of look like they don't know what they're doing. That would just make it worse. All right. I felt like today's stream was a little disorganized, a little jumbled. So, sorry for not having more of a clear, presentation to give you guys. Sometimes it's more clear than others. Today, I really just wasn't sure how to summarize all the things that I was thinking about and present it to you guys. So, but I needed to get on here. I needed to talk to you, not go more than 9 days without a stream. We need to check back in, so we did that. But I just felt like today's stream was a little jumbled because we're kind of in a period of uncertainty, right? Equities haven't really gone anywhere. Bitcoin is still at the all-time high. Labor data looks a little sus, but there's plenty of room to debate about what it means. And we get an inflation report tomorrow after it has been kind of sticky recently. So I think it's okay to acknowledge all those data points and then say, I don't really know what's happening, right? It looks like the economy is reaccelerating, but inflation's not still going down, at least not on a headline basis. So if it's not going to go down this in the report tomorrow, and if it doesn't go down in the report in May for April, then the Fed is going to be kind of stuck in a box. And they're in this policy trap between raising rates to fight inflation and completely choking off the credit markets, which they have done. And now maybe inflation isn't actually dead. And so they have to decide, are we going to, like, to your question, investing attitude, to your question, are they going to raise rates again and actually hard with no lube fuck the credit markets? Because that's what would happen, and risk something very bad blowing up in the economy. Or do they cut rates, assuming victory, hope that inflation doesn't go all the way back up to a dangerous level, and give everybody what they want and just stoke animal spirits even more than they already are? They're really in a tough spot. Neither one of those is a sexy answer. The bullish answer is the most fun because it means the numbers go up and we make money. But that's also the one that puts us into like a hyperinflating spiral, right? It risks those things. And so the answer for a Federal Reserve in this situation is not clear at all. And I do not envy their job. Whatever will support the establishment is what will happen, says L. Buck, unless they lose full control. Well, that's true. I mean, the job of the government is to keep the wheels on the bus. And they are steering the biggest, most inert barge in the universe. And they have to think way out ahead of time about what they're going to do and when they're going to start turning the wheel left or turning it right. And their whole job is to keep the lights on. And unfortunately, in a complex, dynamic system like the U.S. economy, like global financial markets, an increasingly complex system where you have all of these different actors acting in their own self-interests and their own incentives, you end up with a system that seemingly doesn't really serve that many people, because all it seems to serve is those with the greatest influence and those who were here first. And we've pushed things to a point now where I don't think there are any elegant solutions, right? If the Fed cuts rates with the economy where it is, they're probably going to spike risk assets really hard and may reawaken inflation because we already have raging animal spirits. So that's just going to further encourage those things because it will stimulate credit and it will encourage risk appetite. If they raise rates, they potentially hurt small business even more. And all they do by raising rates is increase the income for the top 1%. The top 1% owns all the financial assets. They own a bunch of treasuries, right? They are the ones getting the most money from 5% cash rates in money market funds. So if you raise rates again, they make even more money. They already don't need the money. They're already using that money to bid up financial markets. They will just do it more because debt to GDP is 120%. If you raise interest rates with this much debt, you are just creating more interest income for the private sector that owns your debt. And that's the problem that we're in. That's why raising rates the way that Paul Volcker did doesn't work the same way. Because when Paul Volcker raised rates, debt to GDP was a fourth of what it is today. It was 30%. It's now 120%. The private sector owns most of that debt, foreign and domestic. When you raise interest rates, it's raising their income on those assets. So while it's hurting the bottom 50% by making it hard to get loans, people who use credit to like pay for their groceries and shit, it's hurting those people to raise interest rates. It's helping the richest of the rich. And that's another reason why the economy has seemingly ignored everything the Fed has done. pockets of the economy. This is a shit show economic cycle. The normal linkages are all distorted. They've been stretched out. Some of them don't even work anymore. High interest rates in a period of high debt are actually stimulative rather than restrictive in certain ways. But if you keep them here for long enough, they can become restrictive suddenly in a way that's hard to measure, right? Because it happens on an exponential scale. And so the longer we sit up here, the greater the chances are that we run into something like that chart I just showed you guys, this one, where this comes into play. So, all right. I could do this all day where I just continually rant and rave. I appreciate you guys coming and hanging out with me. It smells like a narrative is about to happen. Yep. I feel like we're in an interesting spot here with the way gold is moving, with the way equities are just kind of hanging out at these levels. After this really strong rally, knowing that we have a bunch more debt issuance coming up soon, and it's going to be coupon issuance, meaning they're going to have to issue 2 years and 5 years and 7 years and 10 years. It's not going to just be T-bills. Net coupon issuance, that's 2 years and longer. Net coupon issuance for the rest of 2024 from today onward is like $1.3 trillion. Starting in this quarter, starting like in the next month or so. I don't know when the next auctions are. And so when you look at, you see the way yields are pushing up, and you know that all this duration, all this coupon issuance is coming. And when the last time the 10-year did this was a correction in equities. And here we are. Maybe we're about to see another leg down in equities. It's something to keep in our minds over the next week or two as we watch the data unfold to see if it's confirming that or if it turns into something else. So, all right. I'm going to wrap this up here. For the next stream, I'm going to try to do a better job of getting all my thoughts in order beforehand and not making myself feel like I'm making y'all jump around a whole lot. So we'll try to do that. We'll aim for the next stream to be this coming weekend. Today's Tuesday, so we'll aim for it to be between Friday and Sunday. I will book it a day in advance so that you guys see it. I think the Sunday stream works better than a Saturday stream. So if I don't do it Friday, we'll just do it on Sunday. Saturday, I like to keep people's Saturdays open, but Sunday feels like a good day to do a little catch up. So maybe that'll be tentatively our next window. If it's sooner than that, you'll know by Thursday. I like doing that Sunday stream. It's a little bit different. The market isn't moving when we do it. So it makes me relax a little bit. I can talk about other things. I don't feel like I got to keep checking on the charts. Maybe I'm missing something. The last Sunday stream was us diving into some history. There's plenty more like that we could do. I got good feedback from that stream, but I'm not going to turn every Sunday stream into a history lesson. However, if you really enjoyed that, make your feelings known. Let me know in the comments, and I'll keep it in mind. Thank you for being here. I appreciate the support. Love you guys, giving me a platform to express my views. I don't sell you guys anything on here. I don't have any sponsors. I'm proud to say. I haven't yet found a sponsor that works for my channel. I have turned some down. Don't know if we'll ever find one. But I appreciate y'all giving me a platform. Like I said, we'll talk again in about 3 or 4 days. So until then, take care of yourselves. Take care of your families. Find some time to enjoy this beautiful spring weather before it gets too hot. And we will meet back here in just a few days' time. Thank you, everyone. Cheers.